This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Statutory Duties. Page 29. Already come across some of the duties, but the following list includes some new ones. Just wondering why I've done this, because there's a better way of passing these on to you. How strange. Alright. Don't remember this page at all. And the statutory duties is a better way of presenting that to you. But we'll probably come across the alternative or better presentation later. So page 29, statutory duties. Already come across some of the duties. The following includes some new ones. Act in good faith, in the interests of the company as a whole, by treating all shareholders equally, declaring any conflicts of interest, and not making personal profits. But we've already come across those, haven't we? I already looked at those first three. Treat all shareholders equally. We didn't specifically mention that. But just because you happen to be a big shareholder, the institutional shareholder, and somebody else happens to own 14 shares, they're still both capital providers, they're still both shareholders, and so they should be treated on an equal, fair basis. But clearly I don't know that that's necessarily going to be so. If you've got somebody who owns 13% of your shares, and you've got me who owns 14 shares, are they going to treat us the same? I don't think so. No, they should treat them all the same in terms of offering them rights issues, giving them bonus shares, giving them dividends calculated on the number of shares that they have, inviting us both to the general meetings, and inviting participation at the general meetings. Yes, in that respect they will treat us equally. But otherwise I'm not convinced. Declaring any conflicts of interest? Yes, but that's what a director should do anyway. He should declare at the earliest opportunity. They should declare any potential conflict of interest. To whom? Who should they declare it to? Conflicts of interest. The company is discussing entering into a substantial contract with another company, and one of the directors who is in the board meeting thinking about entering into this contract has actually got shares in this other company, maybe a major shareholding in this other company. And then there's a conflict of interest there, and that should be disclosed. But who to? Who would you disclose it to?
Maybe it refers to the board.
Well, the rest of the board, yeah. What about a subcommittee, though? What about declaring it to a subcommittee of the board? No, actually. There was a very famous case in the UK, Guinness, you know, the black Irish beer, Guinness, when they were taking over, I think it was Distillers, the Distillers Company, and there was a conflict of interest, and Saunders, the chief executive of Guinness, had a conflict of interest which he did disclose to a subcommittee of the board, but it was held by the courts that that was not adequate disclosure. He should have disclosed it to the full board. So, disclosure of conflict of interest should be to the full board. Everybody should know. It's part of transparency, openness, honesty, and the other word for honesty? Probity. Yeah. Probity.
The examiner, they will not pass the both.
The examiner will be impressed if you get both in. Honesty and you actually make 10 points out of it, can't you? Instead of hairdrift, it could be hairdrift P. Ensuring that the entity maintains proper accounting records. This is a statutory duty. It's been a duty since 1976 in the UK, maintaining proper accounting records, which are defined, but I don't think there's any chance that your P1 examiner is going to ask you what is meant by the statutory definition of proper accounting records. Produce proper financial statements and a director's report. Who decides whether there are proper financial statements? Who ultimately decides whether financial statements show a true and fair view? Who ultimately? You say shareholders, you say auditors. You're both wrong. It's the auditor's opinion that they show true and fair view. It's the directors who prepare the financial statements, in theory, and it's the auditors who then look at the financial statements that the directors claim are true and fair, and the auditors will express their opinion on whether these financial statements, in their opinion, are true and fair. But that's not who decides whether, in fact, they do show a true and fair view. It's just your opinion that they do. Who decides whether they do? Who? Did you? Who?
No, not God.
No. Who did you? Whoa! These are council. So who did you say? The board. No, it's the same as her directors. That's why I couldn't understand what you were saying. It's just the same. Who?
Manager who signs.
Manager of the bank. No. Where do Serena and Venus Williams perform? And Roger Federer, where does he work?
On tennis.
On where? Say it again. Say it again. Again. On the...
No, I thought on tennis.
Right, now miss the word tennis out. On a court. And it's the court that decides ultimately whether. So it's up to the court to make a decision as to whether, in the event of a firm of accountants, firm of auditors being alleged to have issued a negligent audit opinion, they probably won't fight that allegation. It will probably be, they will probably take action in accordance with their insurers, and their insurers will most likely say, don't fight it, let's settle it out of court. Let's just pay the money and get on with our lives. But some firms of auditors actually do go to court and they do defend themselves and say, no, we don't think we were negligent. And then it's up to the court to decide, first of all, if there is a relationship between the auditor and these other people that we don't know about. And then if there is, and they have suffered, and then the court is then going to say, well, is this opinion negligently given? Is it an appropriate audit opinion or not? And it's the court's decision to decide whether or not the audit opinion is negligent, and therefore whether the financial statements show a true and fair view. So it's unusual because the court does not tend to be qualified in financial matters. They tend rather to be qualified in legal matters. So you're going to get these legally qualified people determining whether these financial statements show a true and fair view, which is an interesting prospect. They have to file the financial statements with the government department. In the UK, it's with the registrar of companies, and we also have to file them with the tax authorities so that the tax department can work out whether the tax computation is correct, or even use the financial statements themselves to calculate the tax liability if there's any question that the auditors stroke accountants themselves have calculated it wrong. They also have a duty to obey other laws and regulations, and a particular one which I'll mention on more than one occasion is health and safety legislation. You do get, occasionally in the UK, you do get newspaper articles about directors who are found guilty of failing to comply with health and safety regulations. The one particular one which I remember quite clearly is the one about the man who was in charge of the machine which cut up old tyres. So you throw a tyre in and the machine blades spin round and they cut the tyre up, and then you can recycle the rubber. And every now and then it gets jammed, it gets clogged up. So there is a safety guard on the start and stop button, but of course the safety guard's a pain, isn't it? Because you've got to keep messing it, unlocking it, lifting it up, press the button, put it down, lock it again. It's much easier just to take the safety guard off and just press the button and it's done. And this man went down into this machine which cuts it down with his whirling blades going round. And as he's down there, his 15-year-old son had come away from school early and called in at his father's workplace to say, I'll stay here with you because I've not got a key for the house. And he says, Dad, and his father says, I'm down here, just wait up there a minute for me. And the boy said, what's this button for? And pressed it, and his father disappeared, cut up. Oh. So health and safety, it's the director's fault. It's the directors who have allowed this man to take his health and safety guard off the machine. And it's also your fault, and yours, for not blowing the whistle. As soon as you see a colleague disregarding health and safety regulations and health and safety rules, the company's reputation is going to suffer in the event of an accident. And health and safety rules and regulations are there in order to prevent accidents. So as soon as you see a colleague breaking the health and safety regulations, you should blow the whistle and get the directors down there straight away. Put that guard back on. It's there not for fun, not for show, it's there for a specific reason. Individually, each director must disclose any interest in an entity contract. Well, I think we've covered that. Disclose any interest in shares or debentures, and they must do this. And there is a register kept. As a secretary, a company secretary will maintain a register of directors' interests in shares and debentures. And a director's option interest, and that will also be registered. In addition, they have a common law duty to demonstrate such degree of skill and care as may reasonably be expected from a person of that age, experience and qualification. Failure to do so may result in the director being found liable for negligence, with the consequence that a court may hold the director personally liable for any loss which the company suffers as a result of that negligence. And there are cases in F4 which illustrate the principle of directors being negligent and directors failing to achieve the standards which may reasonably be expected of them from a person of that age, experience and qualification. Page 30, Directors' Appointment and Service Contracts. This is F4 revision. But of course F4 should play a part in P1 because directors and P1 is a big area, or should I say directors are a big area of P1, and they're also a big area of F4. So F4 revision. How many? Well, it was only a couple of exams ago, wasn't it, for F4? It was not that long ago. The appointments. Oh, you read that. You read page 30, for heaven's sakes. I'm not going to stand here and read that out to you. You read page 30. I'll read it for you if you want. I'll read it for you. But you should be able to read that for yourselves. Do we have any problems with page 30? Anything at all which is worthy of further comment? No? I wouldn't have thought so, but I'm always prepared to fill out anything about which you may be a little bit uncertain. Page 31, removal and disqualification. Again, this is F4. Have a quick look together at it. Directors may be removed from office at any time by a vote of the majority of shareholders. That's why Thomas Who, in that question Sentosa House, should be a little bit worried. Because if Sonia and one other, 26%, get together, then Thomas Who's got a bit of a battle on his hand to retain his position as a director. Because at any time they may be voted off in general meeting by a simple majority of votes. In addition, the office of director shall be vacated according to the rules set out in the Constitution, and that will typically provide that if a director becomes disqualified by law under the Company Directors Disqualification Act, it could very well be that where a director is alleged to have been negligent and court proceedings are taken against him, the court may determine that the person is not fit to be a director, and therefore they will lose that position. If he dies, that's always a good reason for vacating your office as a director. If you die, you get taken out, don't you? You're no longer a director. If you're removed by shareholders, just ordinary resolution. If you become personally bankrupt, that's I suppose a practical issue, isn't it? You can't have a bankrupt director. You can't appoint a bankrupt as a director. But of course there's nothing to stop a director from becoming bankrupt. But if they do become bankrupt, then they will automatically be removed, or automatically through the Constitution. Which seems very fair to me. I don't think I would want someone to act as an agent of mine if they were personally bankrupt. If they can't manage their own affairs, why am I letting them manage the affairs of my company? He resigns from office by notice in writing, so you are allowed to resign at any time. And if you're absent from board meetings without permission for a period in excess of 6 months. Now that one always seems potentially unfair. It does mean that if you're in a car crash and in a coma and you're in hospital for 7 months, when you eventually come out of your coma, you discover that you've lost your position as a director because you've been absent from board meetings without permission for a period in excess of 6 months. I think that's the power of the directors to require you to leave rather than automatically you leave the office. Disqualification under the law. This is under company directors' disqualification principles. Allowing the entity to continue to trade whilst it's insolvent without there being reasonable belief that the company will be able to pay its liabilities in full within 12 months. If the company is insolvent, which is just giving you the definition of it, then the court may remove you or may disqualify you from continuing to be a director. Failure to maintain proper accounting records, 3 offences in 5 years. If 3 times you are discovered to have failed to maintain proper accounting records in a 5-year period, then on application to the court may ban you from being a director. Failure to prepare financial statements is the same principle. 3 defaults are failing to file relevant documents with the government department, failure to file tax returns, and taking actions which are deemed by the court to be inappropriate for a director. Page 32, insider dealing. I've already been speaking to you about that this morning as well. So, again, I don't feel any guilt at all in asking you to read this. I mentioned what an insider was, I mentioned dealing, I mentioned unpublished price-sensitive information. So we're down to the bullet point 4 on page 32 before there's anything new. Unpublished price-sensitive information. Unpublished means it's not in the public domain. It's unpublished. Price-sensitive information is price-sensitive where it is believed that once it gets into the public domain, it is likely to have a material impact on the market price of the affected securities. So once the public knows about it, is this going to have a material effect on the share price or the marketable debentures? So that's price sensitive. It's not in the public domain and it is less than 6 months old. So it is relatively fresh information. And it is on publication likely to have a material impact. An offence is also committed if an insider encourages another person to deal. Me being an insider, it will be a criminal offence for me to buy shares with the intention of making a profit or sell shares with the intention of avoiding a loss. But equally, if I were to tell you to buy some shares so you can make a profit or to sell your existing shares so that you would avoid a loss, I am guilty of a second offence. If I have myself already dealt and I advise you to deal, then I'm guilty of 2 criminal offences. Equally, you also are guilty of a criminal offence by taking advice from me with reasonable cause to believe that I am an insider. If you don't know that I'm an insider, then you commit no offence. But if you have reasonable cause to believe that I am an insider, then you yourself will be committing a criminal offence and I'll see you in jail. 2 years. We'd probably be separated. You'd probably in one part of the jail and me in another.
Is it easy to prove it?
No, it's very difficult to prove. Very difficult to prove. I am a firm believer in the fact that anyone that does get caught insider dealing deserves to go to prison, because I think there are enough ways in which you can do it without being found. For instance, if I were to say to Andres, go and buy 20,000 shares in this company in which I'm an insider, and he does, and then we split the profits. It was proved recently, though, relatively recently, within the last 4 or 5 years, about the legal advisor of a company, and the legal advisor was involved in the final stages of negotiations of a takeover bid, and this was on Friday. And he's a qualified, well-paid, the profession is barrister, and he's a qualified, well-paid barrister. The last time I had to use a barrister, I was charged £1,000 a day for his services. So it's a well-paid job. And And at the end of the negotiations on the Friday, he went home and he phoned his father-in-law and said, Monday morning, first thing, go and buy some shares in this company. It's going to be taken over. Now, the father-in-law knows that the barrister is the legal advisor. The father-in-law goes to the bank, and it was a bank holiday. It was a bank holiday Monday, so the bank was not open, so he couldn't borrow money. But first thing on Tuesday morning, he went and borrowed £50,000 and invested it immediately on the Tuesday morning, buying shares of this company. And at 10 o'clock in the morning, on the Tuesday morning, having bought the shares, the announcement is made, there's going to be a takeover bid, the share price rockets up, and the father-in-law sells the shares, which is a good deal. And there's no connection, is there? I have no idea, for instance, what your maiden name was. I know what your married name is, but I have no idea what your maiden name is. So how do I know that you, with your married name, is connected to your father with your maiden name? There's no obvious connection, is there? Is there? Same with me and my ex-wife's father, my father-in-law, and I have got different names, and there's no apparent connection. But this father-in-law, in this particular instance, added up all the sale proceeds and took off the cost of the shares and the difference then is profit, and he wrote out a payment order to his son-in-law for exactly half the amount of the profit. How stupid is that? And as a routine, the forensic auditors, forensic accountants, will look at unusual share transactions shortly before the takeover is announced, and unusual share transactions shortly after. And they got this man's name, buying £50,000 worth of shares on the morning of the takeover and selling them in the afternoon of the takeover. And they think, well, this is worth looking at. So they investigated it and discovered that in fact he is related to the barrister, and the barrister did receive an amount of half the proceeds or half the gain, and the barrister himself is now in court with the father-in-law. They're both in court, alleged to have insider dealt. The son, the barrister, said, no, not guilty at all. It was money that he owed me. And the court said, well, how come it's exactly half the profit that was made? It's an unusual coincidence that the amount that your father-in-law owes you is exactly half the profit that he made on a share transaction, 2 share transactions, which took place within 4 hours of each other. So the barrister lost his qualification. He no longer can he earn £1,000 a day. He's been disqualified, and so far as I'm aware, he's in prison, or was in prison. There was a former colleague of mine, wasn't this insider dealing, a former colleague of mine. He was the managing director or chief executive of one of the subsidiary companies of one of the tuition establishments, which was not this tuition establishment. All right, it's one of the other major tuition establishments, and he lived in the Channel Islands. The island of Jersey, which is a super place, a really lovely place. Lived in a gorgeous house. I stayed with him for a week when I was doing some work down there. And he's just come out of prison, having served 6 years for money laundering, for helping his own personal clients on the island of Jersey to launder money. And the court in Jersey found him liable or guilty of laundering £25 million. And as a result of that decision by the court is then able to seize his assets up to that value to recover the money that has been laundered by way of a penalty. But they obviously couldn't recover £25 million. He's a former colleague of mine, just like any of the other tutors that teach you here. They could only recover 14.1 million. I'm sorry. 14.1 million from a person who is the same qualification, status, position, employee status as me or as John or as the others, and he's got 14.1 million pounds available. Where did that come from? Yeah, it was a gorgeous property. It wasn't 14 million though. Anyway, he's fortunate in the knowledge that having lost his assets, lost everything that he had ever accumulated in all his life, and having paid the 14 million off against the 25 million that he was liable for, And the other 11 million, what happens to that? Do we forget the other 11? No. If he wins the lottery, he'll have to pay all that money over there as well. That 11 million will follow him to his grave. And that's the penalties of money laundering. Don't do it. Just a word of advice. Don't be guilty of money laundering. Nor insider dealing, any of you, nor drug dealing. Don't get involved in dealing drugs. You can take drugs if you want. You can sniff coke and snort coke. You can roll up your £20 notes, and you can do that. You can inject yourself, but don't sell. Don't deal. Offence is committed then if an insider encourages another person to deal. A person dealing as a result of that encouragement, that's you, and believing me to be an insider, you're also committing an offence. And disclosure of inside information other than in the proper course of employment is also a criminal offence. And these offences carry 2-year imprisonment term. But there are some defences. I'm not going to go into the defences. You've actually got one there, or two. You've got two there. The first of them is disclosure in the course of business to a proper authority. That's not insider dealing. Passing price-sensitive information to a proper authority is a defence. And the second one is if I advise you to buy, if you claim as a defence that you didn't know that I was an insider. I can claim a defence. I'm only liable, I'm only guilty if I pass on that information to you, advising you to deal, knowing or expecting that you will take that advice. If I tell you price-sensitive information, unpublished price-sensitive information, not expecting you to take advantage of it, then I'm not guilty. So there are defences, but that's why I say, to be caught in the offence of insider dealing, I think you really have to be rather reckless or stupid. Page 33, Directors, Induction and Education. What's induction? What's induction? Induction is something which I hope two of you in the room are not going to have to face in the near future. Induction it's got two words actually, well, two contexts. One of them applies to two of you in the room, and the other one applies to directors, but they both actually do mean the same. If either of you two happens to overrun your term and you're a week or 10 days late, then you may find that you're going into hospital, and the hospital will give you something to induce the birth. So the birth will be as a result of an induction. All right, your baby will be induced. But clearly that doesn't apply to directors. Well, it does actually. Induction, therefore, is the introduction. It's the introduction of your baby into the world. It's the introduction of directors into a new company. And when directors are appointed to the board, there should be an induction process, particularly for NEDs. If you're an executive director, then the executive directors should be specialists in their own field and should not really require much of an induction process. But if you're a NED, you're a person who's of proven ability. These are people who have shown themselves to be skilled in business, commerce, finance, but they don't necessarily know about the products and the competitors and the customers and the manufacturing areas and the manufacturing process of the particular goods of the company for which they've now been appointed as a NED. So there needs to be an induction process to introduce them to the other directors, to introduce them to the managerial staff, introduce them to the different sites and locations where we're working, maybe introduce them to the major investors, the institutional investors. So induction is like introduction. And this is where the directors, this is what the combined code says, directors should be induced or introduced into the company's activities. It's clearly important that a new director should therefore become acquainted with the executive board as soon as possible after their appointment. So the entity's induction procedure should be comprehensive. It should be, as much as is necessary, fully to acquaint the director with the procedures and processes involved, as well as the personnel. Should be tailored to the needs of the company and individual directors. Some directors will know more about certain aspects than others. Some may have a sound appreciation of the technicalities of coal mining, and if you're appointed as a NED to a coal mining operation, then you don't really need to be taking down some mine in Chile or sent down the Phoenix 2 shaft in Chile to see what it's like to live in a mine. It should contain written information plus presentations and appropriate activities like site visits. Presentation, PowerPoint slides, the company has its own presentation for investor group meetings. Then these NEDs should, and other directors, should have all this information presented to them. It gives new appointees a balanced overview of the company, and it doesn't, or it shouldn't, overload the director with an excess of information, something we were talking about earlier. And at the end of the induction process, the new director should have an understanding of the nature, its business and the markets, a link with the company's employees. Why is that important? Why should these new non-executive directors have forged a link with the company's employees?
So employees knows them and not on the board.
Whistleblowing, yeah. Lend an ear to the whistleblowers so that the employees know to whom they're reporting or to whom they can address their concerns. So we need to know, we need to be introduced to not everybody in the workforce. You know, and this is the person who sits at the reception desk, and this is the person responsible for sweeping the factory floor at the end of every day. So not necessarily being introduced to everybody, but certainly let a sufficient number of people know that you are a person who is a non-executive director and to whom they can turn in the event of any concerns about the company. An understanding of the entity's main relationships, including the relationships with the auditors. It would be sensible, as part of the induction process, to introduce these NEDs to the auditors. And those of you in the room who do work for the Big Four, I presume that on a regular basis you're introduced to newly appointed NEDs. It's a regular thing, isn't it? Monday morning, first Monday of the month, it's the day for being introduced to the newly appointed non-executive directors. This is right?
They don't change so.
They know, but you have a number of clients, all of them with these non-executive director boards, and on a regular basis the Big Four firms will be introduced to the new NEDs. Possibly.